how do companies account for their brands, for their software, for their customer lists, and other intangible assets? I'm going to give you a power 10 minutes on International Accounting Standard 38 because that's the standard that deals with intangible assets. And that's a standard that has been criticised. It's been called an analog standard for a digital age. My name is Tom Clendon, and I help ACCA students pass their SBR exam. I am an IFRS expert. Now, for the avoidance of any doubt, ISA 38 intangible assets deals with things like patents, internet domains, video material, as well as software and customer lists and brands. What it doesn't do is deal with goodwill. That's a separate accounting standard. For the avoidance of any doubt, intangible asset is defined by the standard as an identifiable, non-monetary asset without physical substance, without a physical presence. So these are assets that you cannot touch. They don't have a physical appearance. And they are non-monetary. In other words, this is excluding monetary assets, excluding investments in shares and the like. So the fact that they are assets means automatically that we have to control them. We have to have power over them, and we have to be able to extract future economic benefits. Now, that word identifiable, I think, is interesting. The fact that an intangible asset is identifiable means that it's separable, that it's capable of being sold on its own, or it arises from a contract regardless of whether those rights are transferable. I want to dive in and look at the recognition criteria. Recognition means when you debit and when you credit, when you actually include the intangible asset in the accounts. Now, under the framework, we've got that it has to be, faithful, relevant information when you recognize. But ISA 38 was written before the current framework. And so there's a little bit of a conflict there. What ISA 38 says is that you recognize an intangible asset when it's probable that there will be future economic benefit and the cost of the asset can be measured reliably. Those are the tests. Those are the two tests. Now, there's a number of different ways that intangible assets come to be considered. One of them, and the simplest, is if you buy them. So it's possible to purchase an intangible asset on its own. So you buy a customer list, you buy a software, you buy some fishing rights, you buy some mineral rights, and therefore you credit cash and debit intangible asset. And so there isn't really a problem with measuring the cost of that asset because there's an underpinning transaction. There is much more of a judgment and a problem with measuring the cost of the intangible asset if you've self-created it, if you've developed it by yourself. So you've written the software, you've made the film, whatever it is, because there's not one single transaction. This is sometimes the R&D. So the car industry and the drug industry, the pharmaceutical industry will be involved in a lot of R&D. And if it's if it's research, original investigation must be expensed. But if it's development, if it's the use of existing knowledge to create new products or to enhance existing products and processes, then you do capitalize the revenue expenditure on development. But remember, we want something where we're going to get a future economic benefit and the cost can be measured reliably. So to capitalize revenue expenditure on development, you do need a clearly defined project. You do need clearly defined expenditure. You do need a project which is commercially viable and technically feasible. And you do need a project where you can see, a benefit. You can see in the future that the income will outweigh the costs and that you've got the money, you've got the resources to complete it. What you can't do is capitalize your own brand. What you can't do is capitalize your own customer lists. Very specific prohibitions. Okay? And that's because the money you spend developing a brand, advertising, marketing, is a revenue expense, is written off. And the money you spend on curating and capturing and storing your customer lists, well, again, that's a day-to-day cost. That's the existence of that list is a byproduct of just simply running a business. Uber, Airbnb, massive brands have massive customer lists. They're the two most valuable things about those two businesses. And those assets are not recognized on their own balance sheet because of ISA 38. And that's why ISA 38 is criticized. It's called an analog standard for a digital age. It results in off-balance sheet assets because your own brand and your customer lists are not regarded as an asset on the balance sheet, even though arguably you control them, even though arguably they give you future economic benefit. You're not allowed to do it. Now, the third way of having to deal with an intangible asset is on a business combination. So if I'm buying a subsidiary, what I want to be able to do is to recognize the fair value of the assets of the company that I'm buying, the assets of the sub. Now that sub has been prohibited from recognizing its own customer lists and its own brands. But there should be nothing to stop me in the group accounts as a consolidation adjustment by introducing the fair value of those brands and of those customer lists as an intangible asset into the group account. So rather than have them subsumed within the goodwill figure, if the subsidiary has a brand, if the subsidiary has customer lists, even though they are not recognized on its individual financial statements, as the acquirer, I will recognize them as a fair value adjustment and therefore increase the amount of the net assets that I'm buying and correspondingly reduce the balancing figure of goodwill. And this is an interesting way of, and this is a very examinable way of having to account for intangible assets. Now, once you've got an intangible asset, whether you've acquired it separately, whether you've developed it, whether it's part of a business combination, you've got two big decisions to make. Cost value is one decision, and indefinite life or finite life is the second decision. The cost model is the default, and if you recognize the asset at cost, then it should be carried at cost less accumulated amortization and impairment losses. It's very rare that you will be able to revalue intangible assets. It's an option, but the option is only there if there is a specific active market for fungible items. So that production quotas, fishing licenses, it's very, very narrow. Okay? The other big decision is about whether or not you deal with the asset on the basis of it having an indefinite life or a finite life. Now, a finite life is easy. Yeah, you've got a 10-year license, so you write it off over 10 years. End of. Nice and simple. Yeah, because you know the finite life of that asset. Indefinite life is where you don't foresee a limit to the period over which the asset is expected to generate net cash flows for the business. So you might have a classic brand, something like Guinness, something like Kellogg's, something that goes back over generations. And you are still supporting that through advertising. Now, in those circumstances, yeah, you would do an annual review to make sure that it was still an indefinite life, and you would do an annual impairment review, but you wouldn't need to systematically amortize it because it has an indefinite life at that time. Gosh, that's 10 minutes done. You can listen to this podcast again if you feel I've gone a little bit quick. I'd like you to like, I'd like you to subscribe, I'd like you perhaps to visit my website, www.tomclendon.co.uk. And if you wanted any further help on SBR, WhatsApp me. Yeah? In the UK, 07725 350 793. Or if you're overseas, +44 7725 350 793. My name is Tom Clendon, and I help ACCA students pass their SBR exam. Thank you for listening.